Okay, hit it.
It's July 24th of 2020, episode 90. I'm Patrick Ceresna.
And I'm Kevin Muir. We're not actually here this week. We're on vacation.
That's right.
But we still have a great guest for you. We actually have Harley Bassman, the founder of the Move Index. It's a fascinating interview. Make sure you stick around because you won't want to miss it.
It was a great interview. It's a great summer special. It's going to be a lot of fun. Well, we also have a housekeeping announcement. Lena, why don't you jump on and tell everyone?
So we will be on vacation again next week, but we will be blasting out links to fan-favorite episodes of the past on our Twitter feed and through email. If you're not already, follow us on Twitter at The Market Huddle and subscribe to our email at markethuddle.com to receive the latest episode releases.
Perfect.
So we got to be honest here. This is our third take, and we finally got Lena on the line to do it for us. It's so much better. I think, Lena, you should take care of these things from now on.
All right. Anyway, so let's get to the the interview. Everyone enjoy Harley Bassman, and we'll be back in the first week of August. Thanks, everyone.
Harley, welcome to the show.
Thank you.
It's great to have you. You know, you're the originator of the Move Index and one of my heroes throughout the years. I've followed your career intently, and I'm looking forward to learning more about you and how you got there and the story of your life. Let's start at the beginning. Where did you grow up, and how did you end up on Wall Street?
Well, thank you for inviting me. It's fun to be on the shows over here. I grew up in Los Angeles. Went to school at UCSD, and I was able to pay the tuition when I was at school. There was $236 per quarter. So the beauty of a California education in the late 70s. From there, I went to U Chicago for business school. So I'm a monetarist, and that was when you could still go straight from college to business school. And ended up on Wall Street at age 23 at Drexel Burnham. Mike Milken was in California, so we were a different animal entirely. But shockingly, I was the geek. Now I'm an old man, but we had 3 computers on the entire trading desk, and I was one of the few guys who could plug it in. So there you have
it. Were they Unix boxes? Because I remember in my days they were all Unix boxes. I
think it was before your time, man. These were standalone IBM PCs, 1983.
Yeah, I guess it was a little. It was a little before my time. So you're at Drexel Burnham, and so that didn't last long, did it? Because Drexel wasn't long for this world.
They went down. Wasn't me. I didn't cause it. And I went to Merrill Lynch, and I started their mortgage option business there, and then proceeded to basically kind of keep expanding into other areas of the mortgage market and the option market. Because a mortgage, like a Fannie Freddie Ginnie mortgage, is really just a giant buy right, where the underlying asset is a government guaranteed or government secured mortgage, so there's no credit risk, and it's overlaid with a 30-year option that's callable every month. So it's like a 30 non-call 1 month in swaption lingo. And therefore, you need option technology, contingent claim analysis, as we would call it in business school, to go and back into the value of these securities and how to hedge them. And
so were you one of the first that was using that technology to price that? Or like before you, were they just kind of doing it off the top of their head and by feel? Or even were mortgage securities new to back then? Like you were basically in the Salomon Brothers, Louis Rainery days, were you not?
It was right after Lou's gang at Sully was departing. So Liar's Poker, I knew most of the guys in Liar's Poker. The stories are all true. And that team started breaking up, and 2 or 3 of them actually came to Merrill Lynch at the time. One of them was Howie Rubin, who had that small debacle with IOs and POs. And I sat chairs from him. Yeah, so it's hard to believe that actually at that time it was a $400 million loss. It was the biggest loss in Wall Street history. It was front page of the New York Times. And only a few decades later, some oil trader lost $6 billion was on page C7. That kind of tells you how inflation kind of moves along. But I sat 2 seats from Howie, and around the time I asked my boss for a little more responsibility, and he said, fine, you can take IOPO, which actually is a pretty good deal, because if you're starting at negative 400 million, you can only go up.
That's right. So why don't you tell people about what IOPO means?
Oh, geez. IOPO is simply when you take out a regular 30-year mortgage to buy your house. If you go look at the statement, you'll say you pay, X $1,000, $5,000 a month, or whatever the number is for your mortgage, but X number of it, X dollars go to IO interest, and X goes to P, the principal.
Right.
And those numbers kind of change over time. And what Wall Street did was have the bright idea to say, okay, we're going to take that bond and cut it right in half, and one person gets all the interest and one gets all the principal. And so the interesting bet is, how long will that mortgage live for? And the average time you stay in a mortgage is about 7 years. So you'd get 7 years of interest payments. If you got more than that, you were happy. If you got less, you were sad. And so what you would do is use option technology as well as other variables to try and figure out, will this stream of interest last for more or less than 7 years? And what might change that? And things that would change it would be interest rates, taxes, home prices, the economy. Because a higher economy means you probably got a better job and you're going to move. When you move, you sell your house. When you sell your house, you pay off your mortgage. So that would increase prepayment speeds. So all these various small things, divorce, death, all these things would drive it. And of course, if you're the principal side of it, when the mortgage pays off, you get all your money back today as opposed to 30 years from now. So then you'd be happy. So that was a very interesting product to trade and manage.
Right. So on that desk, you eventually came up with the Move Index. Why don't you tell us about how that came to be and what it was like being the originator of one of the most famous volatility? I guess it was the second most famous volatility index in the world. It's
only famous now. I'm just glad I'm alive to still see it happen, because for the first 15 years, I could barely get anyone to look at it. The VIX came out, it's got to be early 90s, 91, 2, somewhere in there, 93. The VIX came out then. And I was trying to go and find a way to market optionality, options as a product, options as a concept, convexity as a concept, as a risk measure. And implied volatility is basically, that's the way we normalize everything, and kind of make it a number you could deal with. And just quoting a number on a single option, well, that doesn't work because they're always changing. And so the same way, the VIX kind of is a constant number that keeps on going. It's not normalized. It's a number that keeps going up and down. I looked at that and said, gee, we could do that for that technology for bond interest rates volatility. And so I put together 1 month options, which is kind of the same as the VIX.
Right.
And we'd measure options implied volatility for a constant 1 month option on the 2-year, 5-year, 10-year, and 30-year. We weighted it 20, 20, 40, 20, more on the 10-year because that was the most active. And that's the number. And it basically was a way for people to say, oh, volatility is high or is low. It ranged for the first 20 years. It ranged between 80 and 120. And when it got to 120, everyone says, oh, please call me up because I want to go and sell volatility when it gets there. Of course, when it gets to 120, you're hiding under your desk and crying for your mother. So that never happened. And when it got to 70 or 80, the market was so quiet and peaceful and calm, with no risk, available for months ahead. Nobody would buy it. If you actually look at the charts, whenever the move got down below into the 60s, until recently with the Fed, that was always right before then would be the slingshot higher. And the same thing with the VIX. If you look at the VIX, you get the same kind of response. You only get the VIX down into the 10, 12, 14 area when people have no one's buying insurance. Everyone says it's clear skies forever, and then no one's prepared for a risk event. So usually the lower it goes, the higher the move afterwards, and vice versa.
Right. And so is it end up being that Merrill Lynch is actually the provider of that index, or did you farm it out to an independent provider?
we priced it ourselves. It was based on OTC options because there were no exchange options.
Well, that was my next question: is what options it was based on? So those are the over the counter. Just and how would you come up with those prices? From brokers or was it Merrill Lynch pricing?
I was the largest market maker, in the product. I mean, I used my closing book. That was real easy. Now, the index was recently sold to ICE, and they're now managing it for a fee, I think. And I got nothing. I got no part of it. Too bad. Also, they're now using swaptions and then a conversion to make it work. And swaptions are now a much more liquid animal than treasury options. So it's for the average person, there's no difference at all. And it actually is the longest. It's the longest history of volatility in the market.
Oh, it's actually it's longer than the VIX.
The VIX. It's actually longer than the VIX because we actually had data going back to 1989, and the VIX I think starts in 91, 92. So it's actually the longest vol index in the market.
That's awesome.
I didn't realize that. Is there any plans to make an investable product like the VXX or something like that, or even futures on it, or do you view those as abominations that should have never existed?
I think it's a great idea that will never occur. I've been asked about this for 25 years. The exchanges have tried to build products to work off of it. It's just very difficult, and the reason why is that the options, all the products you trade about the VIX, actually are not about the VIX. The VIX is untradable. The VIX is a spot index, is untradable. Everything about the VIX is VIX futures. The roll down, the options, they're all futures. So basically, the move also is untradable. To make the move tradable, you'd need to go and have futures on the move. And the Board of Trade has tried that. And it just never had the liquidity required to make it work. But
I didn't realize that. The Board of Trade actually had futures that were based upon the move?
Very close. There's a TY, which is close enough.
Oh, okay. I see what you're saying.
TY being the 10-year futures contract.
Right. Yeah. Okay. And it just never took off, and so they without that, there's no ability to make an ETF because the ETF they don't actually own the VIX; they own the futures.
The real reason is not a legal reason at all. It's really it's an oxymoron like jumbo shrimp or military intelligence. The issue is this. Options are about leverage, are about gaining exposure, they're about path dependency, all these things that are associated with equities. Stocks are the bottom of the capital structure, and you can actually model a stock as an option where a company has a value to it, and the strike price is the value of the debt because the equity holder gets everything after the debt's paid off. And so basically a stock is an option in terms of limited loss. You can go to zero, unlimited gain. And therefore, people who invest in equities have a natural proclivity to being involved in options also because it's kind of the same idea. Whereas people who buy bonds are buying it as an anchor, as a security, as a low-risk part of their portfolio. To go and layer on a risky concept, i.e. options, and risky I don't mean dangerous, I just mean it requires modeling, it requires volatility, it requires all these various complications. To take a complicated product and put it on top of what is basically your anchor of your portfolio doesn't make sense. And that's why I've never actually seen a huge demand for these products.
Okay. So
it's not that they're a bad idea or we can't go and actually create the product. That's easy to do, actually. And in many cases, it's actually simpler to create a bond option than an equity option. But the natural demand is not there because the people who operate in those markets don't want, complicated securities. They want simplicity and they want, I'm going to buy a bond and it's going to come back at par in some amount of time.
Fair enough. I saw always that one of your old bosses, PIMCO's Bill Gross, was always the seller of volatility. So I just figured that all bond traders were like that and constantly leaning on selling the vol. But maybe I was wrong. So when you're at Merrill Lynch, you're there for a quarter century. Walk us through what happens there, and eventually how you move on to the next part of your career?
In Merrill Lynch, I have only good things to say. It was a great firm, and in the investment bank, in the 80s and 90s, you could do anything if it was reasonable. You had to have risk management tools, but basically, if you have, a fleet of salesmen, you have a lot of capital you can work with, you have a lot of technology and tools to work with, you can create a lot of products. I created, I think, 4 or 5 trademark products while I was there, and so that was wonderful.
Why don't you tell us pick the one that you're most proud of and tell us about it.
There was a product called Preserve, which you've never heard of and you never will. But what it was it was a product for mortgage servicers to hedge out the risk of their portfolio. A mortgage servicer, when you go and have your home loan and you send your check in, it's not going to the bank. It's going to someone to process it and forward the money along to Fannie and Freddie, and they put it along to the bondholders. The servicing would pay basically. Well, the servicer who did all this processing, he would do the foreclosure, he would do the late fees, he would do the ancillary income from selling insurance products, all this stuff, all those kind of background. He would make money as long as the loan existed, and he would earn 0.25% annually as long as that went on. This is basically a giant IO, that 7-year product we were speaking about a few minutes ago, and their entire business was managing this. Well, if rates were to drop, 200 basis points, 2% over the course of a few months, the value of their whole business kind of implodes. And so it was basically an insurance product for this part of the market. It was a very unique product, and it was very interesting, and we sold a lot of it. And the Journal wrote a great story on it in 1991, when rates were still at 9%. But that was a very clever product.
Right. So you're at Merrill Lynch all the way to the 2008 financial crisis. Why don't you tell us about that experience, being there for the big day? The financial crisis is it's difficult to explain. The movie The Big Short is mostly true. I knew most of the people there, and the problem you have is that there's no one villain, and it always helps to have a villain. Who's the villain? The villain could be the government that was encouraging making loans to people who had less than stellar credit. It could be Fannie and Freddie who were buying these loans. It could be the banks who were creating these loans. It could be the people behind the banks who are buying the paper because of low interest rates. It could be the Fed for creating a 1% interest rate environment. There's so many people involved in this thing. It's hard to point to one bad person, but there were, in conjunction, a lot of bad people. And I will say that Dodd-Frank, I'm probably one of the few Wall Street guys who will say it's a good thing. You can't have a game without rules, and the rules, if you want to point to really ground zero, it was removing Glass-Steagall. That was really ground zero for the whole thing. If Glass-Steagall had stayed in effect, I'd still be at Merrill Lynch probably. Right, and it was the merging of the banks and the investment banks, which is what the removal of Glass-Steagall did. And what did it blend? Whereas before the loans were done by banks, and then all of a sudden the investment banking, that blending them ended up making the banks take too much risk. Is that what your thinking is there?
It allowed financial institutions to take on more risk than they probably should have, and although I think if I had to really sum the whole thing up, I'd say the reason why we now have rules where if you own a bar and you serve someone who's clearly drunk, that's illegal. You can't do that anymore. That was kind of the crux of the whole concept. Every little part of the chain where someone would come in and want to do something, and the market would say, okay, you can do it. Did Cutthroat make too many loans? Yes. Did Merrill Lynch build too many CDOs? Yes. But I will tell you, at the very end of the food chain, there were customers lined up down the road to buy these CDOs. We could not make them fast enough. And you look at Goldman, and they were doing these synthetic CDOs. They were making synthetic CDOs because the client demand was incredible. And why was that the case? Well, the Fed had put rates to 1% when they shouldn't have been there, and kept them there. So people were desperate for yield products. Like as I said, there is no one villain. There's a lot of people who did not act in a way that's good for public policy.
So do you think do you think that the Volcker rule was also a good policy? Like, are you in favor of the banks separating their proprietary trading from their client business?
Oh yes, clearly. If you want to go and trade risk, then you should go pay the market price. Whatever it costs you to raise capital is a free market. I mean, you Chicago, I believe in free markets. Whatever the price is to go and raise capital to invest in risky items, be my guest. Banks should not be allowed to borrow money at the government rate, which is what they do when a bank makes a passbook account, a regular savings account, it's guaranteed for $250,000. Because it's guaranteed, customers will put their money in a bank, right? Because they have no risk. It pays a low rate, but so basically banks are able to borrow at 0.25%, 0.5% right now, or back then, maybe 1%. Money's fungible, so that money is then being used or can be used for other things. And that's the whole idea about Glass-Steagall taking apart, merging them together. All of a sudden, the investment bank doing the risky capital, transactions is able to fund themselves at the government rate. That is not a public policy good. When the government goes and allows capital to be raised at a very low government-sponsored rate, that should be used to make commercial loans, should be to make home loans, things that serve the public, not for speculation. If you want to go and speculate, go raise money on your own. So at the core, that was the issue.
So, Harley, if someone made you a benevolent dictator of the financial markets and said that you can put any policy you want, would you just put Glass-Steagall back, or would you make any other changes?
Toothpaste does not go back into the tube very nicely. The problem with Glass-Steagall is it was built in the 30s when basically financial businesses were contained within one country. In fact, they were contained within one state back then. That was part of the problem with the S&L crisis in the 80s, was that you had state boundaries that had to get, and those rules had to get changed. With international rules, the U.S. can't put on Glass-Steagall and force every other institution globally to use it, which is why we have to have these BIS and other kind of rules. You have to have multinational rules, so every bank will be involved in it. So international Glass-Steagall is kind of where we are with BIS. So we're kind of there.
We're almost there. Okay, so you're at Merrill Lynch, and then you move on to Credit Suisse and eventually PIMCO. Why don't you tell us about that stage of your career and what it was like making the move from the sell side to the buy side?
PIMCO's a great firm. I had a great time there. I worked in their hedge fund group, managed money, and it was it was great to come back to California, where I was from. We always had planned to do that, and it worked out very well. PIMCO has a great collection of very smart people, and it was a great place to work. And the one thing I miss about being on Wall Street in general is it's difficult to have a good idea when you're not surrounded by other smart people who want to call you an idiot. And then you have to go and say, okay, I might be an idiot, but how about this idea over here? Having to defend an idea against a smart person is the only way to vet the idea. And so, I write and publish, 6, 8 times a year. It's difficult to do that in your jammies without having someone to go and push back on you and make you think. And, at PIMCO, at Credit Suisse, and at Merrill, a collection of very bright people who had no problem at all pushing back on you to make you think about an idea. And that was great.
That's funny. At PIMCO, you wrote one of these articles. I remember reading it. It was the gold article. And you were telling me earlier that it's your most clicked on article of all time. Why don't you tell us about that experience? Because I think up until then, nobody had seen PIMCO ever talk about gold.
I think, you kind of have to roll back to, where did this whole thing kind of start? What really, the beginning was Greenspan's kind of creating his measured pace from 04 to 06 when he raised the Fed funds rate by a quarter point every meeting and telegraphed, hey guys, I'm raising rates by a quarter point every meeting until I'm done. If you go and tell people that, you could take a lot of risk. You could sell a lot of options. You could take on a lot of risky securities that are hurt by volatility because he's told you, hey man, I'm taking rates, up, and I'm doing it slowly, and I'm doing it at a measured pace. That is terrible. You want uncertainty, so people will be cautious and will not take. It created moral hazard, which is the ultimate negative for a public policy manager, where you encourage people to do bad things or risky things. That's ground zero, and everyone got levered up because of that into the mortgage mess. That's when the MOVE index hit when it's all-time low or close to it. And then when things blew in 08, 09, you had to go and save the system with QE1. QE1 was fine. QE2, 3, 4, infinity, that's not fine. But QE1, you had to save the banking system. We had too much debt. We still have too much debt. Now we have more debt. The only way to get rid of debt is to default or inflate. And inflation is just a slow motion default. The Fed wanted to do that, still wants to do that. And the plan is to go and pump money into the system because MV equals GDP, right? Money times velocity equals GDP, equals PQ, price times quantity, which is the same thing. They put the money
You're showing your Chicago roots there, bud.
They put the money in, right? But then the velocity went down, and the GDP didn't change, or went up by 1-2% a year. What happened was the Fed was trying to create inflation to get rid of debt, and the idea was to have this money go to the middle-class consumer who would spend it, and that demand would outstrip supply, create the inflation they wanted. They don't want, Zimbabwe inflation. They want 3 or 4 inflation would be just fine to go and deflate the value of the debt. Unfortunately, the money didn't go to the middle class. It stayed in the banking system, and the inflation showed up in assets. We've had huge inflation. It's not in CPI, man. It's in stocks, bonds, gold, jewelry, art, cars, everything else. All the assets. Right. Of course, who owns assets is the 1%, and thus you've had even greater income and wealth disparity, which of course is, one of our huge problems now. So the Fed was doing a good deed that just didn't work, and they should have pulled the plug on it after QE1, but they didn't. The idea is to create inflation. And what I said was, this is 2016, is, okay, we need inflation. How are we going to get it? Because it's not going to work for monetary policy. That's done. You could do fiscal policy, helicopter money, which we're kind of doing now, MNT version. But that didn't seem to be in the cards at the time. Yeah. So let's do it the old-fashioned way, which is a repeat of what Roosevelt did in 1934. In 1933, the government made it illegal to own gold. I'm not advocating that, but that's what they did. And they said you have to go give all your gold to the government over the course of a year at a price of $20. Once they got all the gold, where did they put it? Oh, that's why they built Fort Knox, to put all the gold into. After they got all the gold, they took the price from $20 to $35. An instant depreciation of a gold standard world. And there you go. There was the inflation. And that basically the Depression was over after that. You could read the article, I have all the data there, but basically, everything was going up. You had unemployment coming down, GDP up, inflation up. It was all working. They then made the mistake of tightening policy in 1937 and digging us back down again, but it all worked according to plan. So my idea is, let's do it again. Let's go and just have the Fed buy gold. Put a bid for $5,000 an ounce, open the window, all you want. And I think that would be a way it would signal to people that there's inflationary forces out there, It would put money in people's hands as they sold the gold, and it would be a signal to the general population, not to financiers who are working in paper assets. And why not? So that was the idea.
Well, it's a great idea, and I got so many questions to ask you from that. Let's start with the first one. You mentioned, let's start back up to when Greenspan went and decided to raise rates in an expected manner. And I've seen this defended by many central bankers since, and even to this day, they argue that it's more efficient. And I can't tell you the number of economic guys that'll tell me, no, this has actually been a policy that's worked. And me, as a market practitioner, I say I think it's wrong. I think that the Fed should put risk into it, and you shouldn't know if they're going to walk it up gradually or not. And what's interesting is that we're Canadian, and our Bank of Canada governor actually, for the first time in I don't know how long, surprised the market. A couple of years ago, there was no hike expected, and it was priced, maybe with a 25% chance of hike, and he hiked. And this is one of the things that I think is funny, because to me, the market pushes the Fed around. All they need to do is put the expectations somewhere, and then the Fed is loath to kind of not fulfill them. What do you think that policy will change? Do you see a situation where central banks might become more like the Bank of Canada governor, willing to surprise the markets, or is this the mantra that's going to stay, be the prevailing thought for some time to come yet?
Well, you got a couple questions in there. Let's hit the first one first, which is various central bankers or other people defending the policy. I believe it's Upton Sinclair who said the hardest thing in the world is to convince a man of something when his income depends upon it. And so, the central bankers, they have to kind of defend the policy because they did it. They're not going to all of a sudden say, gee, I was wrong. That's not quite human nature.
Right.
Do I think that it will happen now? I think it'll be very challenging. I think the taper tantrum in 2013, scared policymakers. I also think they should have done that in 2011 or 12. And now they've really, taken the debt up so much and made it so if the government had to finance its rate, even 1% higher, it would make a substantial, dent in the funding, the budget deficit, everything else. I almost backed everyone into a corner now where we kind of can't get out of it. So you kind of really, I think because they've got to create inflation in some way, and that will then solve the problem. I think just taking rates up is kind of not going to work.
It's not going to work. So then let's go to the next part of it, which is the fact that what you alluded to is the fact that monetary is no longer going to work, because the reality is it stays within the financial system, and you can't get private sector credit creation because there's too much debt. And so the only way you can actually create money is now for the government to spend it. So in 2008, the government's tried a little bit of fiscal stimulus. They had some cash for clunkers and things like that. But very quickly, the Tea Party came and put the kibosh on that. This time is much different. It seems like both parties are falling all over themselves to see who can spend more money. And it's been a huge amount of fiscal stimulus. Do you think that there's going to be a point where they get worried about that? Or do you think this is a brave new world where they're going to realize that they can spend whatever they want and the taps are unleashed and off to the races we go?
I don't think it's exactly a conscious desire to go and spend money per se. I think what we're backing up to is the point you have not raised is what I speak about most often, which is how demographics drive the economy, stock prices, bond prices, this pig in the python of the baby boom generation. The boomers born 1946 to 64. The first boomers started turning 65 at the start of the GFC, Great Financial Crisis. We're about halfway through right now. So sometime between now and 2028, you're going to have the entire baby boom generation over the age of 65. And boomers in general have not saved for that. They are relying on Social Security, Medicare, and other government support to fund or at least supplement their retirement years, which is now going to be vastly longer. if you age adjust Social Security to what it was in 1936, Social Security would kick in at age 83, not age 65, because lifespans are so much longer than they were, decades ago. And the system was not built to manage those numbers. And I just don't see, and since the elderly as a cohort vote the most, they vote in the high 60s%, maybe low 70s, whereas the 18 to 24 cohort votes at only 44%. They're going to vote for policies that support their needs. And there really is no plan B at this stage of the game to fund Social Security and Medicare without just printing money. And so it's kind of going to happen. The Democrats and Republicans for different reasons. The Democrats for whatever, and the Republicans because their voting bloc tends to be older people, which is why they're now on board for this, where they weren't 20 years ago. I don't see plan B for this. So it's a question of MMT is coming. It's going to come next year or over the next 8 years. It's going to be a problem because people like me don't believe it. I do not believe you could print fiat currency at a rate faster than the growth of the economy without inflation. You have X amount of loaves of bread. If you have more fiat currency in the center of loaves of bread, the price of bread's got to go up. Now, does it happen tomorrow? No. But it will happen. Could it be 10 years from now? I suppose. Could be 20, I suppose. Although the number I use is 2023 to 27. Somewhere in there is my prediction of when you're going to see the inflation interest rates rise, because that's where the labor force growth rate, that's the number of people coming into the labor force from the millennials versus going out of the workforce from the baby boomers, inverts. And labor force growth goes up, demand goes up while supply goes down because fewer boomers are offering goods. That's what's going to get velocity to go up, and that's what will set the fire to the money that's been printed. So that was a long answer to a question you quite didn't ask. But that's going to happen, in my opinion.
Harley, isn't that though very similar to your plan about gold? And isn't that ultimately what we want, and given that there's so much debt that we need to create this inflation?
Oh yeah, sure. Yeah. I mean, yes, it is the plan I favor, but unfortunately, it's not going to end well because we should have done this years ago when we had the window to go and do it. It's now going to happen at a faster pace. If we'd done Simpson Bowles a decade ago, you could have slowly moved the goalposts on Social Security and Medicare. You could have changed the tax policies a little bit just to nudge them along to go and stay a little bit ahead of the demands of the boomers. But because we did nothing for 10 years, we actually regressed. We cut taxes twice. Do I like paying taxes? Not particularly, but it's a price of being in a free society. We think we missed that window. So now it's going to be much stronger medicine required.
Right.
All right. Harley, this is Patrick here, and I want to talk some trading with you. And obviously, we had a great conversation on Macro Voices about the risk reversal trade and things like that. But I wanted to actually start off a conversation with you about volatility in general in the markets, because Kevin recently wrote a piece talking about that the higher markets don't necessarily imply that we have to have lower volatility, and that we could have rising volatility in this period. And I really wanted to kind of size up from you, what's your take on this? Here we are 3-4 months into a market rally, and volatility is still at relatively higher levels. What's your take on this? I know that you have a view that the markets can still potentially continue inflating higher, but do you think that we continue to see elevated volatility levels during this environment?
The number one, I won't say only, but it's number one by so much that it might as well be the only thing. Driver of implied volatility is realized volatility. And in general, for liquid tradable markets, you will see implied vol trade 8 to 12% over realized vol. Boom, done. And we have seen realized vol still being relatively high. And that's why you have implied vol relatively high. And the VIX is not the same thing, this is very technical, is not the same thing as an at-the-money option. It's about 2, 3, 4 points higher because of its construction with skew. So if the VIX is at 28, and which implies an at-the-money option at 24, and realized vol for the last month or so has been like 22, ding dong, right price. You know, when you had the VIX trading at 12, you had implied vol at like 9. So as long as the markets are moving up and down, you will see high implied volatility.
So, Harley, my argument was that I remember when I first started in the late 90s, we had a rising market that was actually experiencing increasing realized volatility. And exactly like you mentioned, volatility was going up even though the stock market was going up. And my point was that just because the stock market's going up, it doesn't need to be this grind higher that we've experienced over the last decade. It could actually be a very volatile affair like the late 90s when you had the NASDAQ double out of the long-term capital crisis and then double again in the final moments of the dot-com bubble, that 4 months. And in there, we had something like 7 corrections of more than 12%.
Patrick, you are a famous chartist. Just pull them out, baby. If we go above 340 on the SPOOs, that's new ground. There's no option strikes per se up there. And so Charlie McGilligan's always talking about, the location of option strikes driving the market, which he's kind of right about. Not completely, but kind of right. You got nothing above. So to the extent we stay in this range of, 310 to 33, 34, vols are going to stay kind of contained. But if we break out of either one of those ranges, you're going to see vols tick up or down. So you are correct that this is not a directional thing. It's a range break concept for volatility.
Now, you recently wrote a Convexity Maven article titled "With a Mighty Hand and Outstretched Arm," and we already had this conversation. I wanted to just circle back to it. And by the way, anyone who isn't subscribing to your Convexity Maven commentaries, you should definitely go to the convexitymaven.com website and subscribe. Just great articles that you put together. Now, at the tail end of it, you were talking about putting on that risk reversal trade on the S&P 500. And this idea of a better implementation in this environment is this idea of buying this slightly out of the money leap. When we're going, you were going out to December of 2022, more than 2 years out, buying the 340 strike on the SPY and financing it with the selling of a put option at a lower strike. In this case, down at the 230 strike. And maybe you could talk our listeners through the rationale as to why you feel that this is a great way of implementing this trade.
As a hedge fund execution, it stinks. So if that's your idea, don't do it. This is a better beta trade. It's an asset replacement trade. It's if you have exposure to the ordinary stock market, SPY, or some other large group of stocks that mimics that, then my idea is to basically sell those things, ignoring tax consequences, and putting this trade on instead. Because what it does is it gives you a lot of upside leverage, but if the stock market backs up by 10, 20%, at expiry, you've lost nothing because this thing expires at 230, 240 out of the money. The way you would lose on this trade is if the market only went up to 340 and stopped right there. Then you'd miss out on your 8% gain over the course of 2 years, just 4% a year, which you could probably make back by just buying some closed-end funds or PIMCO income fund or whatever. And if it trades up, you got a lot more you've leverage on the upside. Because basically, you're owning a call on SPY. And I already said that equities are like an option on a company, on a real asset. So you basically own options on options. It's a very great way to get convex exposure to the market. And I'm taking the risk that the market makes new lows, which I guess is possible, but I find unlikely. The Fed's not going to allow. The Fed's going to fight that. And I also think that I wouldn't say I'm bullish per se because everything seems terrible in the economy, but the Fed's printing money, and the government's going to spend money, and financial assets are a claim on a real business. So in theory, financial inflation should lead to higher stock prices because the underlying income-producing ability of these assets has not changed, assuming they can raise their prices also. And so the real value of Exxon or whatever it might be, Apple, Google, should be unchanged, and its market price should go up with inflation. There is a little bit of the PE will go down when rates go up, but ignoring that small detail, over the long haul. If you look at Weimar Germany in the 30s, they had wheelbarrow inflation of money. You've seen the pictures of those things. Stock market actually kept pace with inflation in Germany. And that is on one of Chris Cole's old commentaries from, about 8 years ago. You can look that up.
Right. So, Harley, it's Kev here. When you think back to your career, when it first started, 30 years ago versus today, how do you think the investing world has changed? And are all the changes to the positive?
Well, and as I always say, it's never different this time. And I don't think we've, reinvented tragedy from whole cloth. I think we're at a different time, a challenging time. But things were worse in the 60s than they are now. I mean, you had National Guard shooting kids on college campuses. We had 3 assassinations. I mean, things were awful. We had bombings. Things were a lot worse in the 60s than they are now, as bad as they seem. Everyone always thinks that their time is the best or the worst or the most or whatever it might be. And it's not. It's human nature, greed, ego, hubris. And so in that sense, nothing's different. Now, trading the markets, markets are in the long term, markets are efficient. In the short term, they're not. And I think it'll be, it's challenging to go and, time these things out. I mean, your investment career is going to be 30, 40, 50 years. And cycles can go, longer than that. So it's difficult. It's just a matter, I don't time the market. I size my trades appropriately. I think sizing is more important than entry level. You size it large enough to make a difference, but small enough so if you're dead wrong, you're not wiped out. That's right. Yeah.
So in there, Harley, you had some kind of words of wisdom. One of the things that I've been a long time reader of your great letter, and one of the things that I notice is that you often encourage people to get out and see the world. Why don't you talk about your passion for traveling and what we think is important in life and with your family?
Well, I have 4 kids. If you go, I also advertise my personal website, bassman.net, where we have a lot of our vacations up there with the itineraries. We've been to all 7 continents. For the person who's not, well endowed in cash, get an RV. Hit the road, man. We did 5 RV trips with our kids, and they were fabulous. And they're inexpensive and easy to do. First one, fly to Flagstaff, go to El Monte RV or Cruise America, get an RV, head north, turn right, Zion, Bryce, Capitol Reef, hook back to the Navajo Reservation, back you go in 7 days. Don't do more than 7 days, you won't survive that. But,
okay, so you got to give us your top pick in terms of traveling in the United States and your top pick for traveling around the world. It's for one day when the COVID's over.
We always travel to places that will be different in the reasonable future. I never took my kids to Europe. That hasn't changed in 1,000 years, and ain't changing in the next 100 either. They can do that on their own. Interesting trip we took. We went to Laos and Burma. Burma it's still a police state. It is very interesting. And Laos is a old French colony. The food is terrific. So that was one of our better trips.
And then what about your top trip in the United States? What did you enjoy? Like, where did you what U.S. destination was your favorite?
Southern Utah is great. Upstate New York, between Albany over to Niagara, is rather interesting. California, go from San Fran and go straight up the Oregon border. That's a good trip. Also, go look for Lava Tubes National Park. It's utterly amazing there, and they'll supply you with flashlights.
So I actually did that trip from San Francisco north. We went to the Redwoods, and I'm a big tree guy, and I was just flabbergasted at the size of the trees and how beautiful it was. And you have to go long distance enough to get outside of like the day trippers, but once you get to there, you get to those trees, and they're just fascinating how large they are.
Sequoia is only a 4.5 hour drive out of LA, so it's a great place to go, and there's some good hikes there.
So one of the things that I always like to wrap up with the Harley is, if you were to go and meet the young Harley, what advice would you give him?
Well, things have worked out pretty well, so I'm not going to change things too much. But I would just repeat, what I've told my kids. The Bassman family motto: never panic, never give up. I think that success in life is really about two things. One, character is number one. Doing the right thing when no one's looking, and number two is just perseverance. I think that in baseball there's the dropped third strike rule, and so most people the ball goes by them and they swing and then the third strike goes by and they're sad and they go back to the dugout. Well, if you keep on your toes and you look behind you, if the catcher drops the ball, you could run to first base and get there. That's kind of the example I like to use for my kids and for people in general, is just keep your eyes open and never give up. Opportunity is there. I'm not sure I believe in luck per se, although I have been very lucky, so I'm happy about that. But I would say that luck is really, opportunity is there. You just have to have your eyes open to look for it. And if you do that, you'll be okay.
Well, Harley, I'm going to adopt that mantra, the never panic, never give up, and I'm going to use that because it's some great advice. Thank you so much for your time. It's been a pleasure having you and meeting you and chatting with you today.
Thank you so much. Have a very good day.
Well, thanks everyone for joining us. We're going to have a week off, and we'll be back in the first week of August. See you all then. Thank you very much.